it's Sarah Larby, guest host and producer of Everyday Investor. Today I'm going to be speaking to my very good friend, Michael Richter. And Michael started a while back investing in pre-construction and then got into the conversions and the BRRRR strategy. And we're going to talk about coach houses and additional dwelling units today. And there's going to be a ton of information, so don't go anywhere. We'll be right back after the break.
For me, it's extra cash flow, right? So, and we'll go over the numbers in a little bit, but for my cost to develop, considering what I can rent that for, there's a large spread, so I'm still gonna be profiting every month. But what I like about this coach house, and this is very specific to the piece of property I bought, is that we have multiple exit strategies. So the first strategy that I could use is I could create a long-term rental, the way I've been doing with all of my other units, which will be still valuable. But my other exit strategy is to do an Airbnb, a midterm Airbnb.
Hey guys, it's Ken Beekendam here from LegalSecondSuites.com, and the tip of the week for you guys is the difference between zoning bylaw and building code. Did you know that in order for your suite to be legal, you have to both be compliant with the zoning bylaw and the building code? The zoning bylaw is put out by the municipalities and it governs the use of the land, such as unit size, could be setbacks, could be number of bedrooms, other things like that. And then we have the Ontario Building Code, which governs the actual building itself. Minimum room sizes, natural lighting, minimum ceiling heights, fire separation, sound separations. And in order for your unit to be legal, you have to be compliant with both. And so if you want to learn more about how and what you need to follow in order to be legal, check out LegalSecondSuites.com/checklist, and you can download an easy to follow guide for how to legalize your unit. Thanks guys, and enjoy your week.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey guys, Omar Khan here from Theta Trading, and here's the weekly market update. What's going on in the markets right now? Markets have had their worst start of the year, the S&P 500, since 1970. That's 52 years. Now the concern of the day is inflation. Inflation is coming in really hot. You see it everywhere. Gas prices, grocery store, clothing, all kinds of stuff. Housing prices. Everything had gone up. Now it's starting to pull back. But because of this, the banks around the world and the Bank of Canada has to raise interest rates so that they can slow the economy enough down so that inflation is tame. That is what they're trying to do. And until that uncertainty is resolved, the stock market is not been in a good position. It probably won't be until there's some good comprehensive data that inflation is falling. And the housing market, being a lagging indicator, is now really starting to get hit hard. Anyways, back to you. We'll see you next week, guys.
Welcome to today's show. Michael, welcome to the show.
Thanks, Sarah. Happy to be here.
I'm excited to have you. I mean, we've been longtime friends, you and Jen, and they say you're the average of the 5 people you hang out with the most. I feel like you're one of my 5, you and your wife as well.
Absolutely.
So really excited to have you today, and let's talk about a little bit of your strategy and also your investing portfolio and what that looks like. So maybe give us a 30,000-foot view about you.
Yeah, so what have we done? We've got several properties in our portfolio right now. We started with new build pre-construction. We built lots of equity in that. As the market changed a little bit, we had to shift. So we got into duplex conversion projects, and we did some of that. So what our most recent project, what that is right now, we're building an accessory dwelling in the backyard of one of these projects. So that's kind of getting my feet wet, getting my toes wet into development, which is what I want to do in the future. And our most latest acquisition actually is a 4-plex in Hamilton that we closed on. So we've currently got 21 doors in our portfolio. So
you started off with a strategy that was a little bit more passive with the pre-construction, then decided to move into the conversions, and now you're going in and you're testing the development world. Why did you feel that you were progressing and you were switching your strategy?
Because what we wanted to do is we wanted to adapt to the market. So in this market, I mean, real estate prices are very high. And cash flow is getting more and more difficult on 2-unit dwellings. So what we wanted to do is we wanted to create a third dwelling to create extra cash flow in this property. And I also picked an area to build this dwelling where I know that in the future the rents are going to increase because of the area fundamentals, and real estate is going to be a lot more expensive. So there's also going to be future opportunity to refinance and pull out more equity from this.
Okay, so you obviously adapt with the market and you have to pivot with the prices. I mean, originally when I started doing the BRRRR strategy, I was just doing single houses and just fixing them up as single houses and renting them out. And they actually used to work back then because I used to buy them at 100, and 50 to 250,000, and then I had to go into the duplex conversions. And now we're looking at, many more units, and you've got to adapt to be able to still cash flow and to do some different strategies. And so walk us through, what your learnings are so far about, adding the coach house and what insights you might be able to share so far.
So one of the reasons why I did that gave me the courage to do that is because right now I'm managing. So these last 2 duplex conversions projects that I've done, I've been overseeing it as the project manager. So this means what I learned from this is that I was able to really cut my costs down by not hiring a general contractor. So I was able to do everything in-house with previous trade relationships that I already had from previous projects that I've done, and from my previous career working in the construction field. I was able to pull on a lot of manpower from that. So what happened is I was able to really get my costs and dial them under control. When you get into development, there's a lot of unknowns because we're not just simply putting a secondary suite in the basement. We're not just simply renovating the main floor. There's a lot of unknown costs. So I created a budget for myself to do this project. But I also know that with the trade relationships I have and the past relationships and my experience, I was also able to bring this and really dial in on what the budget would be and what the high end of this budget would be. So I'm not just guessing on the numbers. I'm not hiring a general contractor who's got to now add in a buffer of margin because of all the variables and costs.
I mean, obviously you've got, a special spot because of your background and your history. Not probably everybody can or wants to do the project management stuff, but I'm just curious, what is this going to cost you, or what are you estimating the cost to be for building the coach house?
So the coach house, I'm putting a round number. I'm using $200,000. I'll be able to do it under that, but I'm allowing myself up to $200,000. What's going to bring it closer to that price point from the estimating I did is basically all the finishings. So if I start to round that number and I want to dial back, I can cut back on the level of finishings that I'm using to really bring the price under control and bring that cost down some well within my budget.
And we'll get into some numbers, definitely on the second half. But, coach houses, I think, are an opportunity of the future. They're still very, very, very new. Why would somebody listening to this at home might want to consider doing that into a backyard that they have the space for, or maybe they're living in a house and they're looking for additional income? Like, what do you think the benefits are of adding the coach house?
For me, it's extra cash flow, right? So, and we'll go over the numbers in a little bit. But for my cost to develop, considering what I can rent that for, there's a large spread. So I'm still going to be profiting every month. But what I like about this coach house, and this is very specific to the piece of property I bought, is that we have multiple exit strategies. So the first strategy that I could use is I could create a long-term rental, the way I've been doing with all of my other units, which will be still valuable. But my other exit strategy is to do an Airbnb, a midterm Airbnb. I know you've got one of those, and it's going very successfully. So that midterm Airbnb is going to bring in business professionals because we're very close to the border. There's a lot of jobs, there's a lot of people that are looking just for short-term employment. So that is one way to rent that. And then the other one is to create a nice little boutique, because we're near wine country, create a nice little boutique rental and rent it out for people that just want to stay there for the weekend and have a very good experience. And the reason why we have these different strategies is because it's on an excellent piece of land where they have their own dedicated entrance, so they don't have to interfere with the duplex tenants. They have completely their own little area, they own their own little backyard, and they're going to be completely segregated because of the shape of the land from the main floor. So that's going to work very, very well for us.
What city is this one in?
This is in Welland.
Okay, awesome. So one of your most recent purchases, I think.
It is, yeah.
Okay, all right. So you're close to the wineries. I was just at a winery this past weekend, and a few wineries actually, I should probably say, with actually Ashley and Spencer, and they were on the show a little while back, and they have some beautiful, beautiful Airbnbs down there, and it made me start thinking maybe we should get a winery or something. Well, they were actually not a winery, but they were like just house right next to the winery, so the backyard was actually the winery of one of the wineries. But it is very cool. So, and we look at fundamentals, and actually just out of curiosity, because you went from like Milton to Hamilton to Welland, like what are some of the things that you like, for example, into these cities, or the fundamentals that you consider before investing in those cities?
So anytime I buy, I always look at, because in the past, and I've had to switch this a little bit, because my whole situation with my job, everything else has shifted, right? So in the past, I was only building equity, and that's why we started buying in Milton, we started buying in Guelph. So we built a ton of equity when I was working full time, and that was just the main purpose, less cash flow, but pure equity growth properties. Now we're buying in areas where it makes sense, where we're still getting cash flow, but we're still getting numbers that allow us to keep scaling our portfolio and growing without sacrificing area fundamentals. So if you look at Welland, where we own property, if you look at Hamilton, it's still well within the Golden Horseshoe. It's still well within the Greenbelt and places to grow. So the government's still going to be putting in jobs, building jobs. There's still a lot of public transit. So these areas are still going to give us the equity appreciation that we need and that we're looking for, as well as cash flow. We can still buy them at price points where we're still getting good cash flow in these properties to keep qualifying and growing our portfolio.
It's about pivoting, right? I think back in the day, you were able to pick one city and one strategy and keep going. But over time, as prices go up and maybe rents don't necessarily go up at the same time as the values of the properties, it is about pivoting and creating some different strategies and some more income as well. And
absolutely. Like in a business, in any business, you have to pivot. We can't just be flat-footed and do what we did in the past. So we have to be able to move and adapt to the new situations, to rising increased mortgage prices, to rising housing prices, and also take advantage of rents that have also got up. So we just have to be really flexible and innovative with how we purchase, and that meant getting uncomfortable and doing construction, taking on bigger projects, and doing the fourplex conversion that we're doing the coach house, so we can stay profitable and keep growing, keep scaling as a business in any market, really.
Now, has it changed also the types of properties that you're looking at, like with the lot size that you're looking at? Like, is that something different now that you're implementing if you're starting with the coach houses?
It is, right? And coach houses are very difficult to find property because you need the land size. Just to have a property with a big backyard doesn't necessarily work. It has to be zoned correctly. It has to have the proper setbacks. You really do have to be an area expert and work with the right people that I can lean on to say, hey, does this work? Can I pull the trigger on this at the extra price point I'm paying? Does this make sense? So you really have to understand the property and when you're buying it. And when I see one of these properties where it works, a large property, maybe it's a quarter property, maybe it's a pie-shaped lot like the one I bought, maybe it has a double lot, then I'll pull the trigger much more quickly because I understand that it's got that intrinsic value of an area where I can build one of these coach houses on.
Yeah, and maybe that's why sometimes you see a property and it's sold for more than maybe somebody else wanted to put into it, but that other person might have seen the opportunity for a coach house down the road in the back to create that additional cash flow. In terms of cash flow, I mean, when you were looking, and we'll dig into the numbers even more, but are you looking at like a cost per night, like at an average worst case scenario, like long-term rental for these coach houses? Like, how are you analyzing the rents that you might be getting?
So I'm looking at this, I'm making sure that this cash flows as a long-term rental, because that's my primary plan, just to create another unit, a third unit, and I know very well what the market prices are going to be from the success we've already had filling the current properties that we've had. So I'm really dialed in on the long-term tenants. But if I were to do anything short-term, if I were to do anything short-term Airbnb or mid-term Airbnb, that's something I've also investigated too. But that's just a plan B. That's going to definitely yield more than what I can bring in currently. But I'm more geared towards long-term tenants, because it's a lot easier, it's a lot more passive. But as gravy, as a way to create more income and pivot a little bit, I don't mind exploring the area of Airbnb.
Absolutely. Yeah. So, as you're building these, as you're acquiring, big lots, properties on these lots to be able to do these homes on, what are some of the steps that, once you're starting to build, that you need to consider? Like, what's a timeline? Are you taking existing garages? Like, walk us through that.
So you have to know, first of all, you have to know what you can do. So you can, for example, you can build on up to 10% of the lot size. So you want it, the bigger the lot, the better. So you're going to pay a little bit more in property tax, but you can build up to 10% of the lot size can be developed into an accessory dwelling unit, but it cannot be bigger than the existing house dwelling that's on the property or the existing basement dwelling if you're doing a duplex. So if you have a tiny little bungalow, well, you're going to have to now know the market. What's your market rent in a very, very small house? I'm not so much into the small units because I know what the tenant profile is that I like, and I'm dialed into that. So I'm building a property geared towards the tenant profile that I want to work with, that end user, that I can market to that end user. So I'm first focused on that. So yes, you do have to know the property sizes. You do have to know what the zoning is, right? You do have to know, like when it comes to development, there's a lot of delays. It's not just the same as, going out and buying a kitchen and putting up paint and putting up floors. One of the big things that I have to wait for right now that I'm still waiting for is permits on this property, right? So we've gone ahead a little bit and we've already excavated, we're already at the point where we can run plumbing. We're prepared, but the permits have taken a lot more because it's the spring market than I anticipated for, right? So that's gonna be a big variable. Then you're gonna have to have ties. You're gonna have to have relationships with excavators. I'm gonna have an excavator that's gonna have to go back about 4 times and a plumber who's gonna have to go back for about 5 different steps that I can depend on, that I've got a relationship with. And I'm working closely with these guys to say, okay, what do you need? What do you need? And they're working with each other. The 3 of us are working together to get set up to the point where we can start building block walls and start erecting the foundations. And then I've already ordered the trusses and the lumber. So that's already in the pipeline, ready to go once we're at that stage. So there's a lot more variables when it comes to development. That's why I wanted to start with this one before I start doing, a strip or an infill development or a much larger house.
All right, you got big projects, big plans. You're doing amazing. Don't go anywhere. We're going to be right back, and we're going to be talking about a specific deal with numbers, and so come back soon.
Hey, it's Kyle from the Kyle Ford Mortgage Team. If you're looking to get involved in private lending opportunities where you can secure your money on real estate and generate returns between 10 and 12%, don't hesitate to reach out at info@kylefordmortgages.com. We'll get a chance to know you, understand you, and your goals in real estate, and also add you to our database and list of opportunities as they come. If this is something that's interesting to you, as I mentioned, don't hesitate to reach out. Thanks, and have a great day.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
Costas Cavellos, founder of First Access Condos. Now, in our world, there are numerous investment opportunities and schemes that people pitch to you daily. Which one do you choose? Which one is right for you? Now, when it comes to investing, you want to invest in something that there's a great demand for, but not enough supply. And everyone knows, in Southern Ontario, the one thing that's in short supply is housing. First Access Condos lets you buy today and reap the benefits in the future. Pay today's prices to invest, sell at tomorrow's prices. That's the beauty of pre-construction condos, and we are First Access Condos.
Welcome back. We are speaking with Michael Richter today, and we are talking about ADUs, additional dwelling units, conversions, and we're going to take a look into one of his newest properties. Michael, talk to us a bit about how you purchased and how you found this property.
So this property is actually on MLS. This is just an MLS deal. It came up, the market, it was a very hot time in the market. But one of the differences, one of the reasons why we got this deal is because I closed firm, unconditional, no conditions, and it was just a cash. And we were able to close in less than a month. So that really helped us get this deal, and there's no other offers on it. So I just gave them asking, and we ended up getting it.
Okay, how much was it?
So this property was $541,000.
$541,000. And when you purchase something and you analyze your numbers, walk us through like how you decide if you want to buy it and how you decide that you maybe want to pass on something.
Okay, so the way I did this, I looked at this I'm more of a long-term equity guy. So the cash flow for me is just gravy, and I use cash flow just basically as a way to keep qualifying for mortgages. So what I did is I looked at this and I said, okay, well, it doesn't really work as a single family home, but if we do a duplex, what's the lift on this property, right?
Right.
So I knew the lift at the time, it was over 700. Okay. So for me personally, the numbers worked, the returns worked for me. But then I started analyzing the property, and then I realized, hey, we could put a really nice additional dwelling unit in the back, a nice coach house in the back. So I called my designer, he gave me the green light, and I was like, I'm going in all cash for this. So I was willing to pay a bit of a premium for that property. I probably would have paid a little bit more, but I just gave them what they wanted to, and we were able to negotiate that deal and close on it.
Okay, all right, so you purchased it for $541, knowing that there's some upside, and it is important to look backwards, right? What is the after repair value, and you break it down from there. So what was the down payment for this property, 20%?
No, I put down 25%.
25%, which is how much?
So I paid $135,000 down.
And $35,000 down. What about closing costs?
Closing costs were just around $11,000.
Okay, which includes like the land
So that
transfer.
that was legal land transfer.
Okay, and walk us through. So this is the actual bungalow. This is not the coach house yet. What were the rentals?
So the rental cost for me was $118,000.
Okay, and what did you spend the money on?
So that was a full secondary suite in the basement. We had to cut in new windows. We had to do a lot of landscaping with that. And that basically gave us high-end finishings. That gave us pot lights. That gave us a custom kitchen. We had quartz countertops on that. And then it was basically brand new in the basement. On the main floor, we got a little bit creative. We just refaced the kitchen cabinets. We painted and we did floors and we did pot lights, and then we did new fixtures in the bathroom. But we were able to really dial in on that renovation budget and still use decent finishings.
I mean, this seems like not a very expensive reno. Is it because you were project managing and you had the trades that you worked with in the past as well?
Exactly. If I used the contractors that I did in the past, the general contractor, it would have been a lot more, and it would have
it would have been just a normal regular price.
It would have been a regular price, right? But because I was able to get a lot more value into it by controlling my own project, and as also at the same time, I was also building up better relationships with the trades, and I was also getting a much better idea of the details that have to go into this project, and then I can now take that and use it on future projects, right? So for me, I love the challenge behind all of it.
Right, and it's a pro and con, right? You're definitely more hands-on. You have you worked essentially for a big builder for many years as your primary job. So for you, it's easy, but for somebody else, a reno like this would cost maybe what, $150-ish, give or take.
For the level that we did, it would have been between probably $165,000 and up to $200,000, depending on the level of finishings that we went to. Right, it could have been.
Okay, which is normal, right? You just got to factor in the numbers. And so in total, how much money do you have in?
So this property here, I think we have. So in this property, we have $79,000 left in the deal after refinancing.
So after the refinance, so what did the ARV come back at?
That was $785,000.
$785,000 was the ARV. So after repair value, so essentially when you're done your renos, everything is finished, you let your lender know, hey, we're ready to send an appraiser in and refinance. Now you said originally you ran your numbers at 700. So you got 785,000.
Yeah, so I mean, this isn't just pure forced appreciation. The market did help. We're in a hot market. The market took off.
Yeah.
So the market did help with those numbers. So that's not a typical return necessarily.
Yeah.
But I mean, you buy into areas with high fundamentals. I mean, these things they're not expected. I didn't plan for it.
Yeah.
But it did much better than we thought.
Okay, all right, amazing. I mean, that's always a nice surprise, right? This is where you can cash out.
Absolutely.
And so how much money do you have left in once you do so basically you're going to do 80% loan to value is going to be your new mortgage. And then the difference between the new mortgage minus what's left, from the old mortgage is what gets refinanced.
Yeah, exactly. So once we pay out the old mortgage, then we'll be able to pay out a lot of our renovation costs that we put into the property. So we have about $78,000 left in the property after the second refinance.
All right, so $78,000. And let's look at the ROI. So what was the appreciation estimate?
So I use 4%. Like this is being conservative. So in 1 year I'll use 4% on that property.
Yeah.
Okay. So the ROI in that property is 58% when I ran my math.
58% return on your investments. What about the cash flow? Are you looking at the whole thing in terms of cash flow with the ADU, or are you looking at the cash flow separately?
Exactly. No, I'm not. I'm using the ADU, the accessory dwelling unit. That's completely separate, right? So what I did is I looked at, okay, 1 year, if we do on average, if we do 4% for natural appreciation, I don't like to speculate more than that. I like to go just above inflation, but still be on the conservative side. So 4% is fair to use that. I'll use 1 year of mortgage pay down and then 1 year of cash flow on that property. That's how I typically run my ROI, and then I'll run it based on what I have left in the property.
Okay, so your return on your investment for this property is 58%, and you were telling us a little bit about how you calculate the cash flow and all that good stuff, but then you've got an opportunity to make additional cash flow and additional return, and so let's talk about this ADU. Can you run us through what the numbers look like for that?
Okay, so for this ADU, how we're doing it right now, I'm self-funding it. So I'm going to put in money up to $200,000. That's the cap for a reno budget. Okay. After that, after it's completed, we'll call the appraiser back. Okay, for the third time on this property, and they're basically going to go through it and they're going to appraise it. So I'm expecting that this is the thing, I'm anticipating $200,000. But the problem is there's no comps for these, right? So this is a little bit of the risk too, is that, well, maybe it's not. Maybe the market corrects and it's not quite $200,000, and maybe it's a little bit less. But we don't have comps because this is such a new concept. But I don't mind leading the market on this one particular project, and then it's a long-term hold for me.
Yeah, I mean, comps being comparables, and because this is such a new concept, and not many people have started doing the coach houses or the additional dwelling units, which is essentially what ADU is, that it's still unknown how the appraiser is going to appraise them and how the lender is going to loan on them. But what ROI are you estimating once that is complete?
So I'm estimating right now, I'm estimating a 40% ROI.
Okay, on the coach house.
On the coach house.
So you've got 58% on the duplex, and you've got another 40% return on your 200 that you're estimating, I guess, for the cost of putting this project together, 200 grand. I mean, that's pretty good.
Yeah.
Plus you could boost the cash flow and for additional return on your investment with some short and midterm rentals. Yeah,
exactly. So how we're looking at this, if it does, like these are the numbers I'm using, I'm anticipating, but if I can forecast a $200, basically what I put into it, and I've got all the bills and all the receipts up to that amount to back up and verify, if we can get $200,000 for that and get a 75% loan to value, that means I can pull out all of that money and leave $50,000 in that deal. But we're going to experience a lot of cash flow coming off of that property.
Yeah, absolutely. I mean, to me, these are cash flow plays as well. And like you said, there are going to be some risks because this is still very new. And we don't know what they're going to appraise for. And also, how are you, so this is the $200,000 that it's going to cost you. You're self-financing that. That's the other thing you got to consider, right? Because until something is built, I mean, you can get, I guess, construction financing, but you might have to find a way to finance these.
Well, and that's one way is myself. But I mean, there's private lenders out there. There's a network. There's people we can partner with to do these sort of things and borrow private money to get to that point. That's just one way to do it, is self-financing. But one of the things that I've realized for this that I made sure of when we purchased this is that I'm going with a credit union. I'm using a credit union on this project. I don't want to go with a conventional bank. And one of the reasons why I want to go with a credit union is because I'm allowed to choose my own appraiser. It can be a little bit more favorable, and they can be a little bit more open-minded because we have a relationship with them, because we've done this before and I've used this appraiser several times, versus a large bank who's just going to assign anybody to it, and then it's going to be up to their own discretion. And they might look at this and say, I don't even know how to appraise this, right? So I've already had those conversations with the appraiser I'm going to be using in the past.
Genius.
And I've got a much better idea of what we can do with this property.
And it's about having an appraiser, I mean, everybody on your team that's investor focused as well as understands investments, because an appraiser can appraise this completely different than another appraiser because one understands how it works and how to appraise it, even though this is still very new. And so if you can pick and choose and mitigate some of the uncertainty, and having that conversation ahead of time is huge if you have that opportunity to be able to do that. I mean, Michael, this was amazing. Thank you for sharing your success so far. Congratulations. It's just a pleasure having you on, and thank you for sharing with the audience.
Thank you, Sarah. It's been a pleasure being on the show.
Awesome, and thank you for tuning in. And don't forget, we are here every single Friday and Sunday. See you then.